So, welcome everybody to Financial Accounting. So for this chapter, we're going to go over an introduction to what is accounting, how is it used in business, and how do we think about it. And then we're also going to go a little bit into analyzing transactions that can happen at a company, and that'll be a preview into next week, what we do. So as far as what we're going to talk about, the nature of business and accounting and how that interacts, and then ethics in business. We're going to describe generally accepted accounting principles, which is the standards that we all abide by as accountants in the US. And then we're going to define the accounting equation, which is how do we think about analyzing accounting transactions. We're going to illustrate business, how the transactions can be recorded, and then how they aggregate up into the financial statements, and how do we analyze financial statements as people that need to interpret relevant information about businesses, right? And then we're going to go into one financial ratio, which is the ratio of liabilities to stockholders' equity in evaluating a company's financial condition. But more than this, we're also just going to talk about accounting as a career path and what you can expect from that, and what my journey to this point in my career has been, to give you guys an idea of, if you're interested in accounting, what you can expect from that. So, the nature of business and accounting. A business is an organization that takes inputs, like materials and labor, and then they produce outputs to give to customers. Generally, businesses are for profit, and profit is the difference between how much they paid for those inputs and how much they got for the outputs to customers, right? So they're getting money from their customers, and then they're spending money on all the goods and services that they needed to give to those customers, and the difference there is the profit. There's three different types of businesses, and these definitions are like being able to classify between these different types of businesses is important, because they have different types of transactions, and so then the accounting for them is different. For example, a service business would provide services rather than products to customers. Service business, such as a software company, is providing a service to customers. Feel free to step in and sit down. Retail businesses sell physical products that they purchase from other businesses to customers, right? They're buying inventory, they're selling inventory. Manufacturing change basic inputs into materials that are shown to customers. So service businesses, right, a big part of their expense is going to be salaries, because it's for people providing a service to the customers, where retail businesses, one of the largest expenses is going to be inventory, and there's going to be a lot of transactions for buying inventory, selling that inventory. We'll get into the first chapter, I think first 4 chapters focus on service businesses. Then when we get into chapter 5, we're going to talk a little bit about retail businesses, manufacturing, producing 1 million expo markers. The accounting is a lot different for it, because how do we determine the cost of a single expo marker when we purchased a whole bunch of materials and paid employees and ran the factory for hours and hours and hours to do it? How do you assign a cost that each one of these probably only cost 5 cents to make? That's in cost accounting. That would be in the subsequent class to this class, managerial accounting, is when you would go into that kind of stuff. And Nancy teaches that class. So you could take that this spring. And so it's important to be able to classify between types of businesses. This is a very valid quiz question that could be for this chapter. So which of the following businesses would be considered a service business? Feel free to blurt it out or anything. B, exactly. Southwest Airlines. It's a service business because there's no physical product provided. They're getting customers from point A to point B. Walmart and Starbucks would be retail businesses. Of course, Starbucks probably has a little bit more of a markup or a value add that could be considered a service, but they're buying and selling inventory, and then Ford Motor Company, of course, buying up a whole bunch of uh, raw materials and making cars, right? So um, I, there there is some homework and quiz stuff on just classifying between the three different types of businesses, but I wouldn't focus too much time on that. And then there's also different types of business activities within a business. So um, businesses can have financing activities, operating activities, and investing activities. Financing activity, so operating activities, that's the day-to-day operations that you think of that a business does. Buying and selling inventory, paying employees that are working for the business, that's all um, that's all operating activities between customers and suppliers. Investing activities would be building new equipment, investing for the future, investing in financial assets. And then financing activities is between creditors and owners. So taking out loans, issuing stock, getting new investment in the business, paying back dividends to back to the owners of the business. So again, financing activities, loans with the bank, and transactions with the owners of the business. So if the owner is going to invest more in the business, or if the owner is going to take out the profits of the business, that's a financing activity. And then these three types of transactions are all super, and that my pointer does not work on the screen, so I'm just realizing that now actually. But basically, these will show up on the statement of cash flows. So there is, I have a video going through statement of cash flows as an example for how to do that, but that's classifying these types of activities. They just go in a different section of the statement of cash flows. We'll probably get to that part of the lecture on Thursday. But I wanted to give that background. That's where we're going to use this. Investing activities, buying new equipment. So new factory, new vehicles, new equipment for the job, that kind of thing. This is all items that are going to be used for more than a year. They're an investment in the future. It's not in today's operations of the business. And we want to classify that out separately because we want to know if that's how the business is using their cash, they're investing for the future. It's really important. And also, what could be in investing activities is buying investments in other, like lending out money to another company, investing in stocks, bonds, or like if a company invests in a startup. For example, if Google buys up this app because they want to add it to their giant collection of software, that would be an investing activity for Google because they bought another company. And then operating activities, the daily operations of the business, insurance to cover their liability or anything, warehousing activities in a service organization or a consulting organization, the salaries of all the people that are analyzing and making the decisions, that's all the day-to-day operations of the company. So the role of accounting in business, we're going to talk a little bit about just background of why do we even need accountants and things like that. It's to provide information for managers in the use in operating the business and to owners or other stakeholders to what's happening, what's occurring in the business. And it can be defined as an information system that reports to users about the economic activities of the conditions of the business. And we can think about there's all these transactions that occur on a day-to-day basis. And we make just a triangle here. There's the transactions. And then the transactions get aggregated up into the financial statements. And then even below the transactions could be like economic activity. because like an economic activity, an event, something happens in the business, we sell, um, today pumpkin spice lattes. They went on sale today. It's fall. It's already here, right? Starbucks sells a pumpkin spice latte, and um, that's an event, right? And then the transaction is they get the cash from the customer, and then they give out the coffee, and then so their inventory goes down, right? And they have to pay their employees. So that's all the transactions that happens. Then the financials is all of these transactions from all of this business transactions and activity that happened gets aggregated up to Starbucks sold millions of cups of coffee today. How much did they actually make? How much did they actually spend? How much did they bring in? They need to know exactly how profitable that they are. Like we obviously know they're selling it at a markup, but exactly what percent? How does that compare to their competitors? That's where accounting is useful. That's where getting in the weeds and understanding how to bring transactional activity into an accounting transaction and then rolling it up into the financial statements is so valuable because it gives us an understanding of what's actually happening in the business. And it gives the owners of the business an understanding of what's happening in the business and us all the opportunity to be the translators for that. That's really valuable stuff. So if we look at this slide here, this graphic, there's internal and external users of these accounting data. And then there's the accountants that sit just in the middle of everything, probably getting yelled at by everybody, but that's okay. Then, right, so they're measuring and recording all these economic events, and then reporting on that financial information, and then the reports, there's separate reports for both internal and external. The managers and employees, they're making business decisions. The investors, creditors, customers, the government, they're all making decisions as to like, do we want to do business with this company? Or do we want to fund this company and things like that? How much, if we're going to lend to them, what interest rate are we going to give? Should we invest in their company? At what valuation? But even nonprofit institutions have to produce financial statements because donors want to know, are their funds being used effectively? What are they spending their money on? And all stakeholders need to know how are they going to interact with the business in that way. And then that brings us to the role of ethics in accounting and business. Ethics is super important because as accountants, we all serve as the translators to get this transaction level data into the financial statements and what does it mean for the business. And there's a lot of trust there. And that means that ethics is super important. Moral principles that guide the conduct of individuals. There could be, there's individual character and then there's cultural character. Individuals need to be honest and fair. However, there's often pressures from all of these stakeholders saying, well, why aren't the numbers as good this quarter? Can't we just do anything? Can we fudge the numbers and then we all get our bonuses and none of us get laid off or things like that, right? Like it's big stuff. There's a lot of pressure involved. And it's just really important to keep that individual character and be like, hey, no, like that's not right, right? And then also, it's super important to be at an ethical company where that individual character is supported, right? And we'll go into some examples here of accounting and business fraud where that ethical culture wasn't supported. For example, I think the biggest example to me is Wells Fargo. There was improperly opened accounts without customers' permission. And basically, they had sales quotas, and everybody at the company, all the branch people were expected to make certain quotas. They were super unrealistic. And so what happened was they were opening accounts without customers' permission or without properly really explaining the accounts. And feel free to just sit down. Yep. And basically, the people that cheated made their quotas. The people that didn't cheat didn't make their quotas, and they got fired. What does that leave behind? An extreme cultural of greed and ethical failure, right? So and my best, strongest advice to you is if you're at a company that doesn't support ethical behavior, leave. Find another job. There are plenty of companies out there. I mean, if you need the money like right now, like of course maybe like you stay for a little bit, right? While you figure something out, but like get out as fast as possible because like it doesn't last. What's the result? Eventually, these customers are going to realize that they had so many accounts open for them. There was no reason for them to open the accounts. They got all these fees. There's going to be complaints. And the CEO ended up getting fined $17.5 million, banned from the banking industry for life. Wells Fargo as a company went way down. The government actually limited how much assets they could have, which for a bank is crippling their growth, right? They literally would have to turn away deposits if customers would want to deposit money over that cap that the federal government set as a punishment for not being ethical. And there's different levels of accounting frauds, right? So that's more of a transactional level fraud, opening accounts for customers. It's a little bit away from, I would say, the accounting element of everything. Enron was an accounting fraud. This was an energy company in the 90s. And one of the biggest frauds, financial frauds in history. There's a really cool book called The Smartest Guys in the Room that it's from the perspective of the auditor that actually uncovered it. The complete ethical cultural failure of Enron. It's a fascinating read, and essentially they were creating fake utility contracts, marking them up to today, and then recognizing all that revenue all at once. But it was all on paper. It wasn't real. It's financial statement level fraud. Like there was no underlying economic activity, and they just changed the financials to say that we made more money than we did. Through a very complicated means, that's what they did. And eventually, they went bankrupt because they didn't actually have the money, right? I mean, eventually, it will, all crumble. Xerox recognized $3 billion in sales prior to when it should have been recorded. This gets into an idea we'll get into more in the future called we recognize revenue when we earn the revenue. That's when we put it on our financial statements. For example, if I bought Xbox Live or Game Pass, right, year-long subscription, and I pay for it up front, Microsoft can only recognize that as the time passes, right? So if it's $100 for the year, they can only recognize $25 in the first quarter, $25 in the second quarter, $25 in the third quarter. Well, Xerox didn't follow this, and they just bumped it all up into the current quarter because they wanted to meet their sales goals. But what happens the next quarter, because they shifted $3 billion from one quarter to the previous quarter, well, now in the next quarter, that $3 billion of sales isn't there, and they're really not meeting their targets, right? Because the growth didn't materialize like they thought it would. And so then it all crumbles. Their executives were forced to pay huge fines. Of course, they're all fired. I mean, I don't know. That's why it's so important to have ethical standards in accounting. So with that, we can talk a little bit about my career path, how I got here. I started out here at Anoka Ramsey, got my AA degree, and I transferred to Hamlin. So if you guys have any questions about transferring credits or things like that, I know how to do it. I took classes in the same lecture hall. I took the legal class with John Gallup. I took econ with Jane Ruffison. Like I know a lot of my fellow faculty here from when I was a student, and I really know. It's been really nice to know the campus, be back. So this is my second year teaching here. Um, so yeah, I transferred to Hamlin. Must have changed my major about 5 times before I ended up doing accounting. And I'm happy I did. There were some internships along the way. I ended up at PwC, uh, working in public accounting in audits of public companies here in Minnesota, and so auditing their financial statements, their earnings reports, and things like that. And um, so I have my CPA license. And then at PwC, I eventually switched to their data team, which is their market data team, providing automated securities pricing for mutual fund audits, which sounds so exciting, I know. Um, but I really enjoyed it. I really like the to get into the technical parts of things, and I basically was working on database design and software for our audit software. And now I'm at Allianz, doing very similar things. Allianz is a life insurance company right here in Minnesota. Their headquarters is in Germany, but their U.S. life insurance business is headquartered here in Minnesota, and I work kind of in the center of their accounting, investments, and investment analytics systems, working on database management and accounting design and things like that. So that's my path, how I got here. Um, I can talk a little bit about salaries of accounting, but I think what's helpful right now is if I just do, this is a Q&A tool. So if you guys can all scan and put in your questions, I find it really useful to do kind of just a Q&A. It's like, how did I get here? Because I mean, I think it was 10 years ago today was when I started at Anoka Ramsey. Um, like, what's my journey been? How did I get here to where I am? Um, and then also, what's the future of the accounting profession? And there's usually some questions about AI somewhere. But so this is a really cool tool. You'll put up questions. They'll show up right here on the slide. If you see your friend has put a question that you wanted to do, you can like it, and I'll answer the most liked questions first. But we'll go about 10 minutes with this. And bear with me as I So I'll let the questions sort of sift through while I talk a little bit about, and I'll answer. Looks like I'll talk about, was it easy to get an accountant job while I talk about just public accounting here, and I'll let the questions sift through, and if you think of something, just add it. Um, So public accounting, this is the accounting career path. Generally, there's two paths in accounting: public accounting, private accounting. Public accounting is accountants employed at an accounting firm. It's a firm set up to do audits, taxes, consulting work, and it's a bunch of accountants, and they so I worked for PwC, which is a Big Four firm. Um, uh, and I got a job as an associate. This is from 2022. I was making less than that at the time, but I think so these are 2022 salaries. Was it easy to get a job as an accountant? I would say yes, definitely. If you get a 4-year degree and you're going to get the CPA exam, it's easy to get a job as an accountant, especially if you start out in public accounting, because the hours can be a lot. It's really cyclical. I would say in the summers, I was working maybe 35 to 40 hours a week, but then there would be busy seasons where I was working, like for our example, my client had a year end at August 30th, 31st. And so between September 1st and November something when they filed their audit, I was working 60 to 80 hours a week. But then the rest of the year, it was a lot less, and I gained so much experience being able to work on Fortune 500 clients as one of the main people testing revenue for key business areas, and like got to talk to controllers, got to talk to some really high up people in accounting that I think I would never have met if I went a different route in accounting. Um, so again, if we just associate salaries at in public accounting firms, so accounting firms in Minnesota, I did my internship at CLA, PwC, KPMG, Deloitte, and EY. Those are the big four firms. Um, and then there's the Big Ten, which also includes regional firms like CLA, which is headquartered in Minneapolis. There's also BDO, Eide Bailly, and other firms. And um, so starting salary for associate in 2022 was average of 62,000. Um, but I would say that it's higher than that now. Like I would say it's probably more like 70 now. And then the advancement is so quick because generally after 2 or 3 years, you make senior associate, and the average for that is 80 as a starting senior associate. But I would say at a bigger firm, it's more like 100. And managers, especially at public firms or big four firms, now it's probably more like 120. And generally, you can get to manager in working in big four or working for another regional public accounting firm. You can get to manager in 5 to 7 years, I would say, from starting as an associate. And so it's very, Mike could be getting the picture that it's very structured. And there's a lot of people that, of course, leave in the first couple of years because it can be kind of brutal, right? But it's so much opportunity there. You just have to work for it. And then senior managers and then partners. Partners of big four firms, this is probably accurate for, so this one is average of big four national firms from 2018 was 750,000 was what the partners make. That is like they were at the big four firm for like 12 years before making partner, and then probably another 20 working as a partner. But so I don't actually know. I think it's somewhere between 3 and 1% of people who start in Big Four accounting end up at the top of the pyramid scheme. But the salaries are quite lucrative, and this is just the beginning of what the Big Four partners can make, because then as soon as you become a partner, then there's another whole pyramid. When I left PwC, I was a senior associate. So I stayed at PwC for 4 years and then switched on to Allianz and I would say that when I made that switch, it was really easy to find a job. And I made that switch 6 months ago or so. So if you have your CPA, if you have work experience, it is the ultimate, in my opinion, the ultimate security. And with that, I think the next most likely question is AI going to take over soon? Which I think is that's valid, right? That's really relevant. So it's definitely changing the way I think that everybody works. I don't think accountants are going away anytime soon. Um, but I think that a lot of the busy work that was traditionally done by us interns, associates, think about what auditing is collecting a whole bunch of receipts, comparing them. If there's something different, asking that question, like, why is that different? And making sure that we know, like, each of those receipts is backing up a transaction, something's happened in the business. Like, we need to know the accounting impact of that. And we also need to know if it's a relevant question to ask and things like that. So the raw comparison, there's tools the big firms are making to do all of that comparison already. There's tools that the tax software companies are making to scan in documents and do all that data entry super quick. Like There are even some free tax software services um, that I used in the last uh, year when I was helping some people at like a tax workshop do taxes, where you scan a picture of a W-2, and if all you got is a W-2, like just working at a job income, it does your taxes. And there's just maybe some things to click through, but there's no data entry. There's no what box is this box is that box. So what does that leave behind for us, all of us accountants to do? It's all the judgment-based work. It's going to take a lot more critical thinking, but I think that what that's actually going to mean is that the value that accountants can provide is actually going to get even more because they're not stuck doing all that busy work. And accountants can get into the same things as lawyers and things like that, where it's a lot of it depends stuff. There's a lot of judgment determining the the squishy stuff and the client management and things like that. Accountants are here to stay. And even so, when I was starting, um, the big hot topic was outsourcing to India, which is still the big firms and even the small firms are doing that a lot too right now, where the audit is going around the clock. Like as a first year associate, I never thought that I'd be able to get to have like three people to delegate to. And so, but I did. And basically all that busy work that I was just talking about, I would have my list of selections that I wanted to test, where there's all of my list of transactions, and I have the invoice, I have the shipping document, I have the payment documents, and I send in, um, you know, I would email them to my counterparts in India. They would work on it while you're asleep because that's during the day in India. And then in the morning, early morning meetings, going over what went wrong, what's all the results, what's things like that. Like that's also still going on too. But all the busy work that's getting automated by AI was already outsourced in a major way. So I think that the work that's still left to do, it's still there. It's going to be even more valuable. There might be slightly less jobs because of it, but the jobs that there are going to pay a lot more because they're managing people, they're managing AI systems, they're providing a lot of value while not doing a lot of busy work. And accounting as a profession is still growing as a profession because all these transactions that are happening are not going away. The companies are only getting bigger. The transactions are only getting more complex, and the need for accountants is still here for, especially in an ethical manner, people need someone they can trust to be able to tell them what happened down here and how does that impact the financial statements at a higher level. Um, okay, other question. If you could go back to college at Anoka Ramsey, what would I change to be more efficient? Um, the biggest thing is just looking at the school that I was going to transfer to and making sure like figuring out what am I going to major in, which is business, basically. I had decided that. I switched between business majors a lot, but I knew I wanted to major in business. Making sure the classes I was taking were going to transfer to exactly what I wanted to happen. I think like from an efficiency perspective, that's really important. I took a lot of art history classes here, like all of them. And I enjoyed them. I thought it was really cool, but I don't think it was the most efficient thing I could have done. I think I needed some of them for other requirements. But just make a big spreadsheet, know what the transfer requirements are, and that's really important. And then I went to Hamlin because they accepted all my credits. That was the main one the primary reason I went there is because um I was able to get through Hamlin in 2 years because I planned it all out. And I did have to take some summer classes at Hamlin, but I just knew that I made a plan and I knew that that's what I wanted to do. And then there was definitely like I had 90 credits, I think, when I left Anoka Ramsey, and only 64 of them ish transferred. But So I would say that's pretty efficient, but at the same time, like that's what I would do differently. I would do um, what's the difference between a CFA and a CPA? Well, the CFA is Chartered Financial Analyst. CFAs mostly work on um, bond valuations, derivative valuations, and like they're experts on the financial markets and valuations of financial items. CPA is accounting, which is much more transaction focused and recording things and like backward looking and making sure that did we record this in the proper way? Was this accounting treatment correct? They're also a lot of times much more legal experts. We'll get into the different legal structures of business um, a little bit later in this lecture, maybe on Thursday. Um, that's the difference. I hope that answers that question. Um, Best class I took for the accounting world. That's a tough one. I think I really liked there was this class in college at Hamlin called Special Topics in Accounting, but it was really more of an SEC reporting class where it went through public companies. They have to report to the SEC, the Securities Exchange Commission, their earnings releases and their accounting reports. And in that class, we went through all of the financial statements for public companies and how do you look them up and how do you find the information that you need. That was the most relevant to the job that I got at PwC because that's what I was doing. I was going through the financial statements, a 200-page document, and making sure that we audited every single number in there and every single number tied out internally consistently. So and the guy that taught that class came from Deloitte, and he was like he had just a ton of experience and he still teaches at Hamlin. His name's Larry Callio. What steps did I take to get internships? Well, I was still at Anoka Ramsey, and I told them that I was trans. I just applied. I mean, especially I think I applied and CLA was a firm that was willing to take a chance on me, so I got an internship there. Accounting internships pay, especially at like a larger firm, like a Big Ten firm like CLA or PwC. I think they pay about $30 an hour. And then if you work in during tax season, you can get overtime. And so I highly suggest taking the semester off if you get a spring semester internship, because then you're delaying graduating by a semester, but you could make with the overtime pay 20 to 40 grand in a tax season, right? And that's I didn't, so did I take it off? No, I was stupid. I was working 30 hours a week at the internship and I was still doing my classes and I didn't do so well at my classes. And by the end of the internship, I had been spending 30 hours. All my peers have been spending 60 hours. So they had double the experience I did. And it was a really clear decision at the end of the internship not to give me an offer to work at that firm because it would like I just didn't have the experience. And honestly, because I was juggling so much, I wasn't a very good intern either, right? So looking back on that, I definitely would have taken the semester off, would have made a lot more money, and I would have been a lot more successful. But that's hindsight. Clearly, like I'm happy with how my journey worked out for me. Like I still randomly applied at PwC for some cybersecurity internship, and they said, actually, you should apply for a full-time role doing auditing. And I said, okay. And so then that's what I did. It's kind of funny how life can send you in certain paths, right? But that's kind of how I found a job. Is a bachelor's degree needed, or can you find a job with an associate's degree? I would highly recommend a bachelor's degree in accounting. You can find jobs with an associate's degree. You can start doing taxes at H&R Block or Jackson Hewitt with a high school diploma. It's a great way to get yourself into the tax space. And so you can apply for those for spring now if you want to if you're interested in like doing taxes. But I would recommend doing a four-year degree because that makes you eligible to take the CPA exam and get your CPA license, which is so valuable. Because if we go back to like public accounting, to go into public accounting, you need to get a 4-year degree as a requirement. And to get to senior, it's mostly a requirement to get your CPA license. And to get to manager, it is like 100% a requirement. You must get your CPA license. And time working in public accounting and also just having that extra experience, if gets you to these other roles in private accounting so much faster. So I would highly recommend um, a 4-year degree. I think a lot of the associate's degree in accounting jobs are also going away. I think there are a lot of the more of the things that can be automated or outsourced more easily. Um, but in my opinion, those jobs are also not as fun and also don't pay as much. So I think there's a lot of opportunity out there with a 4-year degree. Um, and with that, I see all these questions and I would just love to answer them. Okay, 2-minute speed run. 3 biggest stressors. I'm mostly just doing too much. I think that was my main stressor. Um, doing well in school and things like that. Um, how did I land in accounting? Very, very bumpy road. I But basically, I found that I was really good at it and I was interested in it and I thought that I should do it. And I also was really interested in data analytics, and that works well with accounting because you're so close to the transactions. And the transactions make up the data analysis items. And that's exactly what I do now. I sit in the middle of a data analytics team and an accounting team, right? So that it lends itself really nicely to that. Um, how was I sure on going for accounting? Well, I knew that I was between finance and accounting, and everything that I could do, accounting is such a valuable, hard skill to know. Anything I could do with accounting degree, I like I could do the things a finance person could do. But if you put a finance major in an accounting role, they don't have those hard skills. They don't know exactly the treatment of the transactions. And I wanted to know that. And I wanted to be able to do that. And so that's why I chose accounting. And the guy that called me up and told me that, hey, Andrew, you need to major in accounting, and this is why. And that's exactly what I just like for that reason, that you need to get close to the transactions. You need to be able to do everything a finance person could do, but also get as technical as accounting. He's my he's my he's my manager right now. Like that connection from 6 years ago came back around and turned into um, a really good job for me today. I think I already talked about AI. Exams are difficult. The CPA exams are difficult. We can talk about that another time. Or definitely ask me about that after class. How did I start my accounting skills? By taking this class with Nancy, the other accounting teacher here. Oh gosh. Okay. I love these questions. Um, but we do have to get going. Maybe we'll do another Q&A, another class. Um, accountants do a lot more than taxes. Um, okay, generally accepted accounting principles. We have 15 minutes left of class and we are going to use them. And um, but we are on track. We're on track for today and tomorrow's lecture as a whole. But I do want to we are going to speed run some of this stuff. So generally accepted accounting principles, or GAAP, or sometimes called US GAAP. It's the accounting standards and principles that are used in the United States. Other countries, especially Europe, uses IFRS, which is the International Accounting Standards. Um, for example, right, I work for Allianz, a German company. So they use IFRS, and then which is different than GAAP, minorly. Very minor differences, very beyond the scope of this class. Um, but they're the rules that determine how are the transactions treated. And there's some principles and assumptions. With the United States, the FASB, Federal Financial Accounting Standards Board, they're the governing body in charge of setting all these standards. So we get them from them. They make updates to an electronic database called the Accounting Standards Codification, also known as ASC. And changes in the accounting codification are made using accounting standard updates, which are acronymed as ASU. The SEC is the agency of the US government, has authority over the accounting and financial disclosures of companies who have public stock, right? That ownership of stock that's sold and traded to the public. For example, Walmart, right? They're traded on the New York Stock Exchange. They're a public company. Private company could be like Cargill. Cargill's a private company because it's still owned by the family. It's not traded on the exchanges. International Accounting Standards Board, that's the international one. So there's characteristics that we need to have. It's the information has to be relevant to the potential decision making. There's no line item on Anoka Ramsey's income statement that shows how much they spent on expo markers because it's irrelevant. It's going to be lumped into something bigger like teaching expense or instructional expense that's much more relevant and bigger. It's a bigger item, right? That no one needs to know how much money is spent on expo markers. Faithful representation, it's got to be true. Comparability, which includes consistent reporting, allows users to identify similarities and differences among reported items. So that's a big reason why we have GAAP, right? It's like standards and industry standard. There's industry standard metrics. For example, airlines, they're all going to have the same lines mostly on their income statements and their balance sheets so that people can compare different airlines against each other as investment opportunities or for performance tracking. It's got to be verifiable. There's got to be an agreement on the meaning of reported items, and that's where a lot of those FASB standards comes from. It's got to be timely. So remember how I was on a client that the year end was in August. We had to report by the beginning of November, right? Because the users of the financial data have to get it in time for them to make a relevant decision. Because if they're getting that annual report in March for an August data, that's not going to be as useful, right? So there's requirements that it has to be timely information, and it's got to be understandable. People who right now we're learning accounting, we're learning how to read income statement, balance sheet, and things like that. Everybody's got to make it in a standardized way so that it's understandable to the users and things are what they think they are. So there's a bunch of assumptions that go into this. And some of these, okay, there's the monetary unit assumption. Financial reports have to be expressed in a single monetary unit or currency. You can't have a balance sheet and have different lines on the balance sheet for your cash, one in Canadian dollars, one in US dollars, one in euros. It doesn't make any sense. It's not comparable. There's a lot of math involved with even interpreting that. So companies have to standardize it. If they've got for example, a big company that has operations all over the world, they're dealing in so many different currencies, they have to translate it with a lot of calculations all into US dollars if they're a US company, or if they're a Canadian company, Canadian dollars. But they have to pick one, right? Time period allows a business to report its economic activities for a specific period of time on a regular basis. For example, quarterly reports, annual reports. It means like it has to be said, right? They have to say, okay, well, this is our income statement. This is how much revenue we got for the last year. This is how much we got for the last quarter. Internal reports, like where we showed like the internal business managers, they'll get monthly reports. And some companies will even do daily profit and loss stuff, but that's a little excessive in my opinion. An annual accounting period adopted by a company is called its fiscal year. A natural business year ends when the business activities have reached the lowest point in an annual operating cycle. For example, that client I worked on that bought and sold a bunch of grain, it wasn't Cargill. I want to just say that because um, it was not Cargill. Uh, but they buy and sell a whole bunch of grain, um, and they sell a whole bunch of stuff to farmers, right? And so their year end was middle of the summer after they had sold everything to the farmers, but before they had gotten the harvest of everything that the farmers were selling them. That's the lowest point of their inventory level. That was their slowest point in the season. They put the accounting there to make it so much more simple to get a calculation of how much inventory there is. So, for a college, our year end is 6:30 because it's the summer term. There's not as much activity going on, makes it a lot easier. But also, it's the state of Minnesota's year end as well. And we're a government agency, right? So, business entity assumption limits the economic data directly to those activities tied to the business. So Anoka Ramsey's financial statements, which actually be Minnesota State's financial statements, it's only going to be transactions related to Minnesota State. It's not going to be transactions related to the whole state of Minnesota as a government agency, right? It's just Anoka Ramsey. So there's a going concern assumption requires that financial reports be prepared, assuming the entity will continue operating into the future. That basically, for example, an airline, if they buy an airplane and they're going to use it for years and years and years, that's still probably worth the millions of dollars that they put into it. But if they know they're going out of business tomorrow and they're going to have to sell it, it's not worth what they bought it for, right? So there's this going concern assumption that assumes a business will operate into the future. Principles, there's the measurement principle, which determines the amount that actually will be recorded and reported, which basically is, okay, a transaction happened, but how do we actually know how much, say, for example, if we know that we owe somebody money for something, how do we actually know how much we owe? That would be under the measurement principle. An arm's length transaction is between two independent parties. That confirms that amounts are objective and verifiable. For example, a transaction not at arm's length would be me selling something to a family member at either an inflated price to try and get an inflated valuation or a deflated price or lower price to try and get some favorable tax treatment. In accounting, we like to use arm's length transactions to determine what's the real economic value of a transaction. That's what we really care about. So we're going to talk a little bit about, we'll save this for Thursday, but Thursday we're going to talk a lot about forms of business entities. For example, if you've ever heard of an LLC, we're going to talk a little bit about what that is, limited liability companies that protect ownership, and corporations and sole proprietorships and partnerships, and what that all means, both from a legal perspective, a tax perspective, what businesses usually start different types of businesses. But to make it all a little bit more relevant, I just want you guys to think about what type of businesses will you start someday. And so just let that stew between now and Thursday. I'll stick around for a little bit for any questions, but you guys have a great day.